Our final mini lecture from Chapter 7 regards the different types of risk that bonds are affected by. The first type of risk is price risk. Price risk is the concern that rising yields to maturity will cause the value of a bond to fall. And this is just a basic mathematical relationship. Yield to maturity reflects the rates in the economy. As rates go up, the value of outstanding bonds goes down, and vice versa. Okay? So that will cause bond values to change. Interest rates change, so that means that the value, the prices of bonds change as well, of outstanding bonds change. Does a 1-year or a 10-year bond have more price risk? Well, the longer term bonds are more sensitive to interest rate risk, and they have more price risk. What is reinvestment rate risk? Reinvestment rate risk is a type of risk that bonds are also susceptible to. That's the concern that when interest rates and the yield to maturities fall, the future cash flows that are reinvested from bonds will also fall. So here is an example. You can invest in either 10-year bonds or a series of 10 one-year bonds. Both yield 10%. If you choose the 1-year bond strategy where you have to continually reinvest, you receive $50,000 in income and have $500,000 to reinvest. But if 1-year rates fall to 3%, then your annual income would fall to only 15%. If you choose the 10-year bond strategy, you can lock in to that 10% and that $50,000 annual income for 10. So, the conclusions about price risk and reinvestment risk, well, short-term and our high coupon bonds have low price risk, but they have high reinvestment risk. And the opposite is true for longer term or low coupon bonds. All bonds suffer from price risk and reinvestment risk because they are tied to the prevailing interest rates, the prevailing level of interest rates. Third type of bond risk is called default risk. If an issuer defaults, investors receive less than their promised return. Therefore, the expected return would be less than the promised return on corporate and municipal bonds. Bonds that are issued of the U.S. government have no default risk. Only corporate and municipal bonds suffer from default risk. Default risk is influenced by the issuer's financial strength and the terms of their bond contract. So how do we determine how municipal and corporate bonds, how susceptible they are to default risk? Well, luckily for investors, there are a couple of firms out there that grade bonds. In other words, they assign these ratings to bonds that give us an indication of their probability of default. So Moody's and Standard & Poor's are these two services that provide this information to investors. And as you see in this particular table, as we move from left to right in the table, bond issues that receive those ratings, they are more susceptible to default. So that means they have greater default risk. Of course, they should have a higher rate of return, whereas bonds that are more on the investment grade have a less risk of default and have a lower rate of return. So bond ratings are designed to reflect the probability of a bond issue going into default. So here are some factors that these rating services analyze when assigning bond ratings. They'll look at the firm's financial performance through various ratios that we've covered in this class, such as the debt ratio, the times interest earned ratio, and the current ratio. It'll also look at some qualitative factors. They'll look at the bond's contract between the issuers and the investors. Is the bond backed up? Is it secured by certain assets, or is it unsecured? Is it senior? In other words, does it have a first claim on earnings and assets, or is it further down the line? Is there a guarantee and sinking fund provisions, which reduces the amount of debt outstanding on a regular basis? And what is the maturity on that debt? And some miscellaneous qualitative factors. Well, what would happen if a firm that issued bonds could make its coupon payments on a regular basis? Certainly the bondholders could force the firm into bankruptcy. So if the company can't meet its obligations, it would first file for Chapter 11, and that will stop its creditors from foreclosing, taking assets, and closing the business. But the business has 120 days to file a reorganization plan. The court, meanwhile, appoints a trustee to supervise the reorganization, and management usually stays in control. But this is going to be their Hail Mary pass, hopefully that they can move the firm forward with a reorganization. And the company must demonstrate that plan, that reorganization plan, that the company is worth more alive than dead. If not, the judge will then order the liquidation under Chapter 7 bankruptcy. So in liquidation, what is the series? Who stands first in line when it comes to a claim on earnings and assets? As we've mentioned before, it's those secured creditors, those lenders. And who's way at the end of the line? The common stockholders, because they have a residual claim. In a liquidation, unsecured creditors generally receive nothing. This makes them more willing to participate in reorganization, even though their claims are greatly scaled back, because at least they're going to try to, get something with a reorganization versus a liquidation. And various groups of creditors can vote on the reorganization plan. If both the majority of the creditors and the judge approve, well, then the company can emerge from bankruptcy with lower debts, reduced interest charges, and a chance for success. And I believe That's what we saw in one of our previous chapters when we analyzed the financials of the De Leon Corporation.